Welcome back to the Educated Homebuyer Live. With me, once again, Mr. Josh Lewis, our certified mortgage professional. Josh, welcome to the show.
I thought you were trying to chase me away. It was sort of like one of those, what's the little thing that makes the high-pitched noises and chases the pests away? So I was the pest and your music was the high-pitched noise.
Dude, I do things intentionally just to get a reaction out of you.
I see
It's
that.
fantastic. I see that it works. So here we are, a new week. And this week we got some updates on existing home sales, or maybe that was last week. Don't remember. We got some updates on Case-Shiller home prices showing that both home prices, existing contracts, as well as new homes are, kind of moving up, if you will, in addition to some movements with interest rates. So tonight we're going to talk about interest rates. We're going to talk about inventory. We're going to talk about inflation, some economics, if you will. And then we're going to answer your questions. So Josh, where do you want to start?
You want to just go into the data? We had three reports this week. We had new home sales, we had Case-Shiller, we had FHFA, and we've been talking about them the last few weeks. Last month, if you remember, the numbers weren't the greatest, and right before that, we had NAR's figures on the median home price that got a bunch of publicity, and we wanted to talk about why that wasn't the best data. So all the data this week looked great. But the question we got to ask, Jeb, does that mean everything's great? Is housing back to a bull market and going to be awesome?
Yes.
So
no, not necessarily. But let's look at the numbers and see where it stands. I've got the slides coming in now, so we can do that here in just a moment as they pop in. There was an issue with my file, so it's trying again. Josh, do you want to try?
You corrupted your file?
There's a possibility that took place. There we go. So let's do this. We are adding it to the stream, and we are big heads on the screen because that's what you guys said you wanted. So, yeah, there we are. So, Josh, what are we looking at?
So, signed contract 683,000, up from 623,000 the month before, up from 648 in January, 622 in December. So the highest number we've seen in 6 or 7 months. Median price was also up. So the change year over year, last year we're at 707,000 annualized new home sales and down to 683. So actually fairly similar to this point last year, which had started trending down from a very hot market. So really, it's just another measure that tells you that the market is stabilized. Builders did a pretty darn good job. Unlike 2005, 2006, 2007, when they were just building like crazy right into an overheated market, they backed off. They've been slow playing things. We have a lot of permits, a lot of things under construction, but not a lot of completions coming to the market. Mm-hmm. If you look at completed new homes actually for sale, Jeb, I think the number's like 1.6 months right now. So actually very tight inventory. So this number was above expectations. And why is that? Partly because of that low inventory number. Another one is low inventory for completed, ready to go homes. So they're selling a lot of the ones that they do have, but there's not a lot of existing homes on the market, not a lot of home sellers. Builders have to sell these things, right?
And I showed a chart last week that 31% of the inventory on the market is new construction. So new construction is making up a good portion of that inventory, a third, if you will. And there's a chart that I was going to put in tonight. I don't think that I put it in, but it shows new housing starts. So housing starts are at the lowest level that we've seen since 2019. So housing starts are it's not like they're increasing, right? So builders backed off a little bit because of probably inflation, the cost of money, just different things out there. So yes, there's new inventory coming to the market later this year from some of the new construction, but it could be short-lived in the big picture. So, yeah.
Jeb, you talked about a week or two ago in the Cromford report, which is the Arizona market report, saying that probably the hottest segment of the market, the things that were actually going up and selling the fastest, was new homes that were available and ready to move into, especially things that fell out of escrow. We were talking in the fall, people were backing out because they had signed contracts with much lower rates. And like, I don't want to go under contract at this. Now buyers are willing to pay for that inventory that's falling out, and we'll pay a little bit of a premium for it. There's 2 or 3 people saying, hey, want a house, need to negotiate and have it done right now. On top of that, builders are heavily incentivizing buyers. So 2-1 buy downs, covering closing costs, all that stuff. So long way of saying that's not like a gangbuster number, but it's a good number, and it's a good sign that we've probably seen the worst of things. Doesn't mean it's going to go and get a ton better from here, but probably seen the worst of it, especially if rates continue to cooperate. You're showing here Case-Shiller 0.2% month over month, 2% annually. So you look at the top cities, San Diego up 1.5%, Los Angeles up 1%, San Francisco up 1%. So Jeb, we've been talking about this a little on the show the last few weeks. If you look at the numbers that you and I know are valid numbers, no one's cooking the books, and you're seeing these areas where we operate in. I do loans throughout the state of California, a lot in Southern California. You sell in Southern California. We're like, where are these prices coming down? My buyers are not seeing it. I know they happen. I know they're real, but this is pretty reflective, right, of what we're seeing with buyers throughout the state of California right now.
No, absolutely. And we've talked about it. I mean, it has everything to do with supply, right? If we had a ton of supply on the market, we wouldn't be seeing these increases, if you will. It's the fact that interest rates have come down a little bit from the peak, and we've got tight supply, and there's still quite a bit of demand out there. So it's still, if you're in the market shopping for a home like right now, chances are what we're talking about. I mean, you guys are commenting on the video. In fact, I just put a video out this past Monday on California. The number of comments in there saying, yes, this is exactly what I'm experiencing right now in the market is, it rings true, because that's what's happening in the market. And there's, really good chance that the next report, you're probably going to see something similar with an increase because of the amount of demand in the market.
So, the next chart there, Jeb, it's also Case-Shiller, but I like to give a look. The infographics are great. It tells you what happened this month, but no context. This goes back to January of 2000. Goes back a long time, huh? So shows you that we had dipped and gone negative month over month, and now it's back slightly positive. And you and I have talked here, Jeb, for months. The story here is interest rates. If interest rates are cooperative and stay below 7%, we will bounce around that 0%, plus or minus, slightly up, slightly down. The lower rates go, the more we're going to go up. I don't think there's really a recipe for month over month 1%, 2%, 3% gains anytime soon, but we should be able to stay positive as long as rates stay in the 6.5 and below range.
And I agree. And there's a chart later in the video in this slide deck here that basically came from Vanguard, showing that they're expecting a further decline into, I don't even remember if it was this year or next year, but they're expecting more of a recovery in 24 and 25. Anyway, just an interesting chart that shows you all perspectives. We're not here just showing you, hey, this is one chart, this is what we think. We're going to show you the other side too, because again, varying opinions coming from different places, and Josh and I like to read all the data, listen to different people to get our own perspective on what's happening. And we don't always 100% agree on everything either. And so it's just good to get different context and be able to apply it to where you are in your home buying, career, if you will.
And Jeb, just on these numbers, just to reiterate, why do we show all the numbers? Well, new housing is different than existing housing, depending on where you're at. We want to look at both and see those numbers. FHFA and Case-Shiller are good numbers to look at. FHFA is homes or loans that are going to Fannie Freddie. So it skews towards sort of middle of the market. It doesn't have jumbo stuff. It doesn't have cash buyers in there. Case-Shiller is a repeat sales index. That's kind of the best way to measure this. So it's generally the most accurate, way better than a median price. So we kind of want to look at all of these. So FHFA here, up 0.5% month over month, and then 4% annually. You can look at the regions. This shows Pacific down month over month. And yet we just talked about Case-Shiller has California, most of California up 1% last month after, probably being cumulatively down 4 or 5% over the prior 6 months. So it's interesting info there to look at. Another view of it, Jeb, here is just showing the prior year versus the most recent year. So the blue lines there are 21 to 22, and then the red lines are 22 to 23. So you can see FHFA is reporting positive. We had a negative month there, but very much moderating from where it was even just a year ago, which is good. I mean, we don't ever want to see numbers unless you know unless you know that you're going to sell and get out of the market. You don't really want a 20, 24, 25% year over year increase in home values. It's just not healthy for the market. The one thing I wanted to show in there, Jeb, this is from the FHFA. U.S. house prices increased slightly in February. Dr. Natalia, not even going to try how to say her last name, supervisory economist in their Division of Research and Statistics. This increase was in part due to a decline in mortgage rates by more than a half percentage point from the peak reached in early November, as well as historically low housing inventory. I do think interest rates tell the story, but that's a little off and misleading because homes that were closing last month, rates had already gone back up a little bit. We've had some volatility. December and January were pretty good, and February and March not so much. So these are March closings. They had already spiked back up a little bit.
Agree. And I think that's more or less what I said just a bit ago. So this was taking a look at inventory as we do every week. So inventory increased about 2% this week. So does that mean we've seen a bottom in housing inventory? Hard to say. I think there's a chance. But, it's weird because if you're looking here at Orange County, our numbers are actually less than last week. So we actually have less inventory than last week, sitting at 2,013 homes here in Huntington Beach at 136. So Orange County inventory, Huntington Beach inventory has actually gone down. Nationwide inventory went up a little bit. So I'm not calling a bottom in inventory quite yet, but I don't think you're going to see a big decline from here unless, something major happens in the market in one direction or another. I think you're kind of bouncing along here, seeing small increases in inventory, if anything, or small decreases, if anything. Nothing major taking place. Chart, again, just another way to show that inventory level. And the reason I like this chart is it takes us back to pre-2016, just shows you where inventory was during those times and where it is now. So yes, we're off the bottom, but relative to where we were, in 2019, 2020, I mean, significantly higher. Just it's always good to know where you're coming from. And again, the reason that we saw inventory pick up, we saw new listings pick up. Looks like we're sitting somewhere near, I can't see it on my chart because it's covered, but what's that line? The dark 2022 levels. So we're somewhere near the bottom of the April numbers in 2022 with regards to inventory. So inventory, again, we talked about picking up. This one, again, weekly new inventory showing 80,000 new listings coming to the market compared to 88,000 last year. So less new listings coming to the market. And out of that, you saw I don't have the number in front of me, 20,000 of that went into escrow immediately. So a good portion of the escrows or of the property coming to the market is still getting taken up pretty quickly just because of that demand out there. Again, new pending home sales per week. Sales rate running 15 to 20% fewer than last year. So we've got less pending sales. Why? Why do we have less pending sales, Josh? Is it because of less inventory? Just less properties to choose from? Is it less buyer demand? Is it a combination of all of that plus interest rates? What are your thoughts?
I would say it's 80% what's available. There's just less homes available. And 20% is that we just don't have as much able demand. There's plenty of demand. Lots of people, lots of people here every week that would love to buy a house and can't afford at the current prices and interest rates. So it's that combination of affordability is keeping able demand out of the market. And those that are able and willing to do it are having a hard time finding a home they're happy with and having to bid against other people for the few nice homes that are out there.
Agreed. I thought this chart was interesting. Did you put this one in, or did I put this one in?
You did it. I was just looking at it. I jumped ahead while you were talking, Jeb, and I also found your chart very interesting.
Oh yeah. So basically, just shows when we saw slower home sales, when we saw rates rise and it impacted slower home sales. Goes back all the way to the 70s on there. It just kind of shows you how rising interest rates impact the number of sales, something that we've talked about all the time. When they say, home sales are down 22% year over year, if you're surprised by that, that's surprising to me because what you would expect to have fewer home sales when interest rates more than doubled in a year's time. And this just basically goes back and shows you, the different times during that happened. A lot of it had to do with, them raising the Fed funds rate to fight inflation, just different, impacts in the market. The one time that during, that I can remember, specifically, and all of you guys can as well, is, that had nothing to do with that, was basically just COVID coming into the market, which was that one right under this bar. COVID happened to the market that year, less home sales, just because, housing was essentially closed for a couple of months in a lot of markets out there due to the pandemic. This one, again, showing median home list price versus the median new price of new listings coming to the market. Both of those ticking up as we're heading into the spring. And again, median price of homes going under contract, pending home sales sitting at 379,500, 1.4% below last year. Nothing really significant to see there. What do we got here? This is the chart from Vanguard, basically just showing they're expecting a rebound in 24 to 25, but at the trough, they're expecting somewhere between, I think it was a 5% decline is what they were thinking in the median home price, and which it looks, based on this chart, somewhere latter 2023 headed into 2024, but they expect us to start the incline from that point forward. Hard to say if we've had the bottom or not already. I personally think we're going to see just slow activity in the market. What that means, it's hard to say. It means less sales for one, but like Josh said, a lot of it has to do with interest rates. A lot of it has to do with what sellers decide to do with their homes when interest rates are higher. I mean, we know a lot of them are locked in, but we don't know how unemployment is going to affect, those that are homeowners. Are they going to have to list? How much of that comes to the market? How much of that new construction that's under contract comes to market? What does that do to supply in different areas? That's the question.
And just hold on before we move forward from that one. We talked about the CoreLogic report for April, and again, CoreLogic, we talked through the pandemic about how crazy these people were. They kept talking about prices were going to go down, so we don't hold them up as the paragon of information and what to rely on. But they're forecasting 3.7% year-over-year appreciation in the year going forward. So Vanguard here is projecting that we're going to be negative well into 2024. So about this time next year, it looks. Would you say that crosses over about end of Q1 2024?
Yeah.
The story is going to be interest rate dependent. Jeb and I argued about this earlier today. But if rates moderate as we expect and are under 6% for the majority of the rest of the year, we're not going to be negative. If rates stay elevated, go above, say, 6.5, this is a reasonable forecast. So it's not the worst number, not the best number. We like to look at them all and consider biases and past performance when looking at who has the best numbers.
No, absolutely. And then this chart goes to show this is wages versus inflation. So inflation or wages just crossed over the inflation number for the first time since March of 2021. Is that right? March of 2021-ish. So wage growth is still going up while inflation is coming down. Does that improve housing affordability? Maybe for some, but not to a large degree for most people out there. And this is a look at weekly initial jobless claims, basically just showing the number of claims, again, starting to rise. Josh, what did you want to add on that?
Just again, looking there, that dotted line there, everyone wants to relate a lot of numbers and look back to 2019 because it was pre-pandemic, pre all of the Fed stepping in and doing crazy stimulus, pre the Fed stepping in and jacking rates to the moon. And we're just above jobless claims for that 2019 average. We're starting to see an uptrend, and this just relates back to that is what the Fed is wanting to say. And Jeb, the chart that you had there before that, this is really good. We need wage inflation above real inflation so that real income growth is happening. If inflation is 6% and your wage increase is 5%, you lost money. And over the last 2 years, we've seen that. So this tells us here that if we have more jobless claims, we're probably going to be slowing down in terms of wage growth. If it's let more people looking for work, they're going to be able to command less money. So that's just an element of inflation. So hopefully inflation moderates, get back into that number. Jeb, you and I looked at a report yesterday that sort of hinted at something we actually talked about 2 to 3 weeks ago on the show. The way CPI is measured undercounts housing costs when rents and home prices are going up, so it understates inflation. The Fed looked at that and said, see, inflation's not a problem when housing costs were going through the roof, and they did nothing. And then it overstates housing cost inflation when they're moderating or coming down. And that's where we're at right now. If you take housing out of the equation, we are under 3% CPI inflation. So I'm not saying you can just ignore that. It is real. But what we're saying is 6 to 12 months down the line, with all of the housing numbers that we just looked at, they're going to be similar to where we're at right now. Not much higher prices, not much higher rents. We're probably going to have more unemployment, lower inflation, lower wage growth, but that's going to be a much more normal economy, bring us back way down on interest rates, which will stimulate a little bit the real estate market, but not to a huge degree.
And likely recession coming, Josh. Again, chart here looking at all the U.S. economic recessions in the past 100 years. Average was 17 months for the average recession. Anything you want to add on this chart?
Nothing other than to say since 1980, we've only had 2 that are anywhere near that long. So 81, 82 before most of our times, and then 2007, 2009, the Great Recession. So this 6-month, 8-month, throw COVID out. COVID was a joke. I mean, it was a real thing. COVID was not a joke. The recession related to COVID was a joke. It was just a weird one-time thing that happened. So I think a moderate recession, 6, 8, 10, 12 months. I don't think we're going to get 17 months, but they're generally deflationary, disinflationary, and will help sort of reset and moderate some of the cost growth that we've seen. So Jeb, I don't know if you've noticed here in the comment section, I believe we've already had 32 questions about this.
About this right here?
About
I have
this
it. LLPAs. So yeah, this is good. We're going to talk about this in more detail. So you want to save this chart separately and we can pull it up?
Yeah, we can come back to
we can pull it up on the screen here in just a minute. Lastly, what are we looking at here? Is this the 30-year
this is the spread,
and
just the
Treasury?
spread showing you, I mean, it's coming down, but we had this head fake a few months ago where we got the spreads down to about 2.5. We're still up over 2.8. We will know the mortgage market is kind of healed and normalized when we get somewhere close to 2. I don't think we're going to be back under 2 anytime soon, but somewhere 2.2, 2.4 would be reasonable, and it would get us that 30-year fixed rate in the mid 5s, which would be supportive of home values.
And where are we today? This is an idea of where we are.
Yep. So the Freddie Mac numbers we talk about, they release them every Thursday and they gather them on Monday. So even when they're released, they're late and out of date. So that Freddie Mac data, take it with a grain of salt. Mortgage News Daily gathers these daily, and they're generally pretty accurate. As of today, I was running a bunch of different scenarios. Most people can do a 6.5 at 0 points on a standard balance conventional loan. They skew heavily towards direct lenders. So ignore the FHA and VA at 6 and an 8. Those are closer to 5.5, 5 3/4 for borrowers with 640 plus credit scores. But it gives you an idea of where we're at. That 30-year jumbo, helpful to look at just because that spread was at least 0.5% below your standard 30-year fix just 2 months ago. The banking crisis, such as it is, has led to a little bit of a decrease in those spreads in the jumbos. They're still better than Fannie Freddie because they're generally bigger downs, better qualified borrowers, higher net worth, that type of stuff. But it's worth noting, jumbo loans are a little more expensive relatively than they had been. Jeb, we also had a question in here that we can actually answer.
Well, let's get through this real quick and get one so we can get this off the screen and get us back to normal size here. So one other chart I just wanted to throw up, which was distribution of origination interest rates in Q4. So this is where interest rates sit, today? 23% or so. People have an interest rate sub 3. I can't see them on my screen. The numbers are too small here. Let's see. Nearly 40% have an interest rate between 3 and 4. Another 20% have an interest rate between 4 and 5, and then between 5 and 6 and 6, you have a little bit more. So this is a little bit different than the 90% we've been quoting below 5%. But this was updated as of Q4 2022. So nevertheless, you got a lot of people locked in sub 4%. what, 61%?
Yep.
61% locked in under 4%. That's the reason you're having those issues. But Josh, I know you wanted to talk and address a question. So let's remove this and
Just trying to find the darn
this.
thing. So here, Nicole Jansen's regular viewer here says, how come the adjustable rate mortgage rates are higher or the same as the fixed 30-year rate? What's the point of getting those in this market? I thought they would be lower than a fixed rate. Well, right now, the belief is that inflation in the short run is going to be higher than it is in the long run. So paradoxically, like if you're going to buy US Treasuries, the 3
I
month.
can't get over the fact that you look like you're on your knees and I look like I'm standing on a box.
Well, you are standing on a box.
Hold on. Let's see. Is that better?
That's better. That's better. Now we can actually see there's a picture behind you. So if you were to go buy treasuries, a 3-month treasury is going to have a higher yield than a 10-year treasury, than a 30-year treasury. And the reason is, the belief is that over the next 3 months, 6 months, 12 months, 3 years, 5 years, inflation is going to average more than it will over the next 10 to 30 years. So as long as we have that inverted yield curve where short-term rates are higher than long-term rates, there's not going to be much, if any, incentive to take a hybrid arm. I have seen there are a few depository institutions, whether they're credit unions or community banks, that are lending their own money that will have some type of a discount on a hybrid arm. But for the most part, there's just no point in doing them in the current market.
All right, good stuff. So hopefully you guys got some value out of that first part there, going over all the economic data out there. This past week, what did we talk about? Home improvements on the podcast. So if you listen to the Educated Home Buyer podcast, you probably already talked about it. We talked about value add stuff, things you can do to a property you're planning on buying, things you can do to a property you already own to increase property value, help with that appreciation, if you will. So if you haven't listened to it, go check it out. It is on Spotify. It is on Apple. And there's also a YouTube channel around the Educated Home Buyer podcast where you can actually watch the videos and listen to the content. In fact, we have more or less the whole catalog on there at this point in some form or fashion on the YouTube channel. So go check it out. Subscribe to the channel if you haven't done so already. That would be helpful for us in helping us accomplish our goals here. But Josh, let's talk about it. Let's back up. Big G seems to be the won the night so far with the number of comments, and a lot of it is coming from not only Big G but other people in here talking about the Biden rule, talking about LLPAs, loan level price adjustments. What does it mean for the market? So instead of clicking on every single one of these questions and bringing them up on the screen, two things. One, I filmed a video on it. It comes out Friday. I get into detail about all of this, what it means for low credit score borrowers, what it means for those with higher credit scores, who it really impacts. So check it out. It'll be released Friday morning. But Josh, big picture here. Does it really mean anything, in your opinion? Who does it impact? Is it really as big of a story as they're making it out to be?
It's going to push a lot more people to FHA loans. Most folks, if they were shopping with a competitive lender, like we just showed that chart,
right,
that the nationwide average says that FHA loans are 3/8 lower than a conventional loan. I can tell you, every borrower I've looked at in the last few weeks where either one of those is an option, it's been at least 0.75%. And for lower credit scores, it's 1.25%, 1.5% better with an FHA rate. That's a monster difference. We used to say that if you had above a 700 credit score, it starts being worth looking at conventional because the mortgage insurance is cheaper if you have a higher credit score. Well, we also had a mortgage insurance reduction a few months back on FHA loans from 0.85% to 0.55%. So when we look at that, mortgage insurance on lower credit scores, lower down payments, minimum down, is generally significantly better on an FHA. Rate is significantly better on an FHA. So whatever in the world the FHFA, who dictates these rules to Fannie and Freddie, thought they were accomplishing, they are not going to accomplish it. We had, Jeb, a quote here. This still boggles my mind. I told you I was triggered earlier today, so we're going to read this. So this is director of the FHFA, Sandra Thompson, came out and responded to the misinformation that's been going around. And she said, the changes to the pricing framework were not designed to stimulate mortgage demand. The fees associated with a borrower's credit score and down payment will now be better aligned with the expected long-term financial performance of those mortgages relative to their risks. Now, the simple thing to say is bullshit. You guys are not in the loan business, and 2 or 3 of you already pointed out in the comments that literally you get a worse rate when you put more money down. There's no world in which it's riskier to a lender when a borrower has a bigger down payment. So they're lying through their teeth. Who knows why they did this? Jeb, why don't we pull the chart back up real quick, that fancy colored one, because what this shows, like, to the right side, this is the right 2 columns are greater than 95 LTV and greater than 97. Almost no loans are done at greater than 97. Those are things with a combined loan to value with down payment assistance. So over 95, cool. Everyone gets a better interest rate. So 97% loans are going to be better for everyone. But now we go anywhere from 85 or 80 to 95%, and credit scores all the way down to 680. Everyone's getting worse. So the red there is worse rates for the people with higher credit scores and more down. And the green, everyone putting less down gets better rates. So there's literally, there is no justification for this. And what we're seeing, Jeb and I were talking about this earlier today. If we had a bell curve, if you've ever seen a normal distribution, the old bell curve from high school and college, the majority of activities in the middle of that bell curve. Well, what we just saw there is almost all of us that are doing somewhere between 5 and 20% down and have a credit score somewhere from 680 to 800 are going to be paying higher rates. So they can improve terms for the 3% down across the board, because very few people are doing those because mortgage insurance is high. There just aren't a lot of them done. And then they can ignore people to the left of the bell curve because there aren't a lot of loans done there either at lower loan to values. So they just hit almost everyone that's getting a loan. She goes on in this press release to then talk about investment properties and second homes. Well, we can have that debate. If Fannie and Freddie don't want to be in the game of financing second homes or investment properties, cool. Get out of the game and let that be private banks, independent mortgage banks, mortgage companies. But this is just silly what they've done to their LLPAs over the last year and a half, starting with the second home and investment home adjustments, and then with this adjustments relative to scores. What I can tell you is many, many, many more of you will be doing FHA loans, and you're going to see FHA volume go through the roof. So if we want to attribute this to Biden, because he's the man at the top, although he probably has no idea what's going on here, well, we have Marsha Fudge over at the head of HUD, who just made things more lenient, cheaper. And then we have Sandra Thompson over here at the FHA making things tighter and more expensive. All we're doing is shifting risk from something that is in government conservatorship with a government implied guarantee to FHA that has an actual government guarantee. So it's crazy. We didn't help the government price risk at all. We just move risk from one pile to another.
All right, so there you go. Question for you guys out there listening. Can you hear the construction going on in the background? Because we're sitting in a building where they're doing a lot of construction, and I can hear everything coming through my side. So it's kind of a pain listening to it all in the background. But I was wondering if you guys can hear it, because if you can, then obviously that creates additional issues. But if you would just let me know in the comments, because it's helpful to know what you guys are listening to. But I'm going to click on a couple of comments here. So Pulse Powered says, do you think builders in the market will be willing to go down in price if the house doesn't appraise? SoCal area. So here's the thing. I've never been representing a buyer on new construction where the house didn't appraise. Typically new construction appraises. They have the ability.
It's magic, Jeb.
Yeah, it's absolute magic. But in all reality, they have the comps, they have the data to support why one home may be sold higher than others, because they can show builder upgrades or whatever the reason is. So I would say, would they be willing to? Maybe, probably, especially if you're using their lender. There's a really good chance that they might be willing to negotiate on some of that stuff. But overall, it's not even going to be, it's a non-issue because the property is going to appraise to start with. So there's less even concern with it not coming in. But I would imagine if it didn't appraise, chances are they'd be willing to negotiate. But it's probably in your 500-page contract that you sign when you go new construction.
Jeb, one of the reasons for that is they will reduce the price as an absolute last resort. They don't want to have sold Jeb a model match 2 months ago at $700,000 and now sell Josh the exact same house, the exact same upgrades for $680,000. That's a problem for them. So they'll buy down your interest rate, they'll cover your closing costs. They will do anything to avoid cutting that actual sales price. That becomes a matter of public record, that becomes a comp for the next appraiser to come through. So that's part of the reason why it is very rare for new construction to not appraise.
And good stuff. Back up one whole question here where we're talking about the LLPAs. One thing Josh didn't mention that I remember, I was kind of zoning out because I was looking through some other stuff, but this has already been priced into your pricing. So if you've been shopping for a loan for the last 30 days, this pricing is already out there. So I know it's set, May 1st is kind of the date that's everything, that's being reported on the media and all of that. It's already in effect, guys. So if you're getting pricing, you've had pricing, you're locked in, that's already part of it. So it's not something new that you need to worry about at this time. Now, there are additional LLPAs at the moment that are going to come in as of August, I believe, that have to do with DTI. Now, that will impact things as you get closer if you're, borderline there on the DTI unless something changes. So, but at the present time, it's already priced in. So
Jeb, I'm very, very happy that you brought up the debt to income one, because if the current LLPAs aren't pushing enough people to FHA, the over 40 will push everyone to FHA. Like it will be like, because it's not a small, like I believe it's a 50 basis point hit for going over 40. It might be more than that. Whatever it is, it's big relative to these small changes. And the other thing, we had a question here just to kind of close the loop on this. Big G had a follow up, said, well, people put less down. Will they ding their own FICOs? This is insane. No, they will absolutely not, because the people who haven't lost their minds are the people that have to insure these loans and actually price the risk, the mortgage insurance companies. So when your score goes down and your down payment goes down, your mortgage insurance goes up and up and up. So the differences in your interest rate are pretty minimal on those LLPA adjustments relative to how much you're going to lose in mortgage insurance. Watch Jeb's video. When we kind of penciled out the numbers and pulled some MI numbers, you get to lower down and lower FICOs, like no one's going to do it. A 640 credit score with 3% down and one borrower, you are never doing that loan. You're going to go FHA.
And it's not, this is more, in my opinion, of a media headline. This is not making housing any more affordable, just so you know. It sells the idea of affordability. Does it lower cost in some ways? Sure it does. But in no way, if you're stretched at a 620 thinking, I don't know if I can afford this house, are you going to think, well, that changed it, I'm good to go now? No, not going to happen. So just so we're clear. Let's talk. Let's get off that for a moment here, Josh, and address Kim's question. Says, what is a lender credit? So somebody's getting a lender credit. What does that mean?
Think of it as reverse points. Most of you are familiar and comfortable with the idea of paying points. So if today's interest rate is 6% and I want 5 3/4, so I have a lower payment, I have to pay 1 point. So the lender takes 1% of the loan amount as an upfront fee, and they say, okay, I'll take less over the lifetime of the loan in that form of that lower interest rate. They'll go the other way. If the rate's 6% and you say, hey, I'll pay you more each month by giving you a 6 1/4% interest rate, they go, cool, that's more than we need to make on the loan. We will credit you 1% at closing. And those are the general rules of thumb. We've been in a weird market over a year now. So the further you get away from that par rate, in the example that I just gave you, 6% is the par rate. They don't require you to pay a point. They don't give you any credit. The further you get away from that, the less benefit you get, or the more you have to pay to go lower, the less of a credit you get for going higher. But in general, the rule is paying a point will get you a 1/4% lower interest rate. Going a 1/4% higher in rate will get you a 1% of your loan amount lender credit to cover towards your closing costs.
Oh man, I love these because I don't really care, but I'm going to click on it. It says, Jeb, I came across a video live stream of another realtor that I suspect to have taken shots at you, calling you a reckless cheerleader. Well, here's what I would say. Go back, just say 3 years. Go back 3 years on videos. Watch what I was saying in March, April, May, June, July, every month. I'm not going to go through the entire calendar here, through 2020, through 2021, through 2022, up until now. and fact check based on what that person was saying. So I don't know who the other realtor is, but if it's a clown in Northern California, he does like one deal a year.
A year.
So a year. So let's not call him a real estate agent.
And Jeb, we've actually had 3 or 4 people here in the comments say they've spoken to him and he tried to talk them out of buying during the period of time when homes were going up 20% a year. And if they had listened to him, they would be significantly poorer. So the other piece of that I would say, Jeb, we had people starting to take a victory lap in the fourth quarter of last year. Yep, here we come. Home prices are going down. And we said, home prices can absolutely come down. It's going to be dependent on interest rates and what that does to affordability. And we're always going to continue to have the supply issue. We don't have a recipe for a massive crash. So home prices can absolutely come down, and we don't have a recipe for them appreciating rapidly, but we do have the perfect storm for this sort of chop down the middle, depending on what happens with interest rates.
Agreed. So Andre says, thanks for your advice. I just closed on a house in the Midwest for $250. It appraised for $255. The cash closed was $18K, which was high, but I made it work. Thanks again. I thought there was a question there. So you're welcome, Andre. Congrats on the purchase. That's awesome. He also got a rate of 6.625, he says, and he can't wait to refi. So I think you'll get your chance. Don't know if it's 2 months, 6 months, a year, but there will be an opportunity to get rid of that. I'm confident in that. Platinum Black. Any advice or content about buying a primary residence remotely? So I have talked about buying a property out of state before. I would say there's 2 different types of buyers. I can't even think because it's so loud in here. My desk is vibrating from what's going on outside. So
we may have a short show tonight.
Yeah. So if you're familiar with the area, it's one thing, right? So I'm going to assume that, well, let's address both. If you're not familiar with the area that you're buying in, go get familiar with the area, spend a little bit of time there, understand what the market is, understand, what drives that market, what employers are there, what drives housing, all of that stuff, because it's important. And the reason I bring that up, you might be saying, Jeb, you're crazy. Why would I buy a house in a city I've never been to? There's a lot of people that did that over the last couple of years. They've been there once, don't really know the market. They think, hey, I want to go to Nashville. I think Nashville's cool, and have never been there. Nashville's awesome, but you should go there and check it out before you invest, your entire life savings into a down payment and buy a house. But buying it remotely, it's really about knowing where you want to be, right? So location's everything, and finding a really good real estate agent that knows what you want and can guide you through that process, and somebody that's not afraid to tell you that's not the right house for one reason or another. Or when they're video walkthroughing, because I've had clients buy property remotely, via FaceTime or what have you, and having an agent that's willing to point out all the bad things about that property that may push you away from buying it, but just so you're fully aware and that you're not surprised when you get there and find out that the neighbor that backs to your house is a complete slob and has got stuff, all in his yard, and it just looks, like somebody you don't want to live beside. True story. That happened, during the pandemic. My clients bought back to a house remotely that it was like that. And I pointed it out. I put my phone over the fence. I'm like, this is what you're going to live behind. Just so you guys know, they were cool with it. They still bought. They're very happy that they did. So those are really the important things. Lending, less important. I mean, find a professional mortgage lender, but that lender can be in your market and just be licensed in that out of state. So you don't necessarily need someone in the new state, but location, knowing where you want to be, knowing what you want in a house, and having that pro are really the things I would focus on. Josh, anything you can add there or want to add or don't want to add?
I would absolutely, these people during the pandemic that bought, and the first time they saw their house was when they showed up.
Oh, yeah.
I don't know how you could do it. Like I'm a control freak. I get it. I could understand putting it under contract, but at least go out and see the property during your contingency period so that you don't.
I had multiple people buy houses, like never saw them until they moved in.
If it's an investment and the numbers pencil out and someone else did an inspection, walked it, and you're cool. But I mean, if you have to live in it, I want to talk to the neighbors, knock on a few doors, go to the restaurants in the area. It's like I couldn't fathom doing it, but I know a lot of people did it, and that's great for them. Wouldn't work for me.
Good stuff. Mace, May says, will we ever see 2 to 4% interest rates again? I've been noticing the actual price of homes have been dropping a little bit, but not the interest rate. So, Josh, let's just address the first part of that question there. 2 to 4% interest rates.
So if we normalize to say under a 2% spread between the 10-year Treasury and mortgage
If or
rates, when we're going to, but I'm saying something weird changes and we never get back there. But I expect it to get to 2, probably closer to 1.7. That has been the 10-year average or so. But at 2%, you need a 2% Treasury, a 10-year Treasury, to get you there. We're at 3.4, 3.5 right now when inflation is hot, the economy is wonderful per the Fed. It wouldn't take much to get it down to 2%, 2.5%. So yeah, we will absolutely have rates in the 4s. If we go off of the recent history of the last 20 years of government intervention, anytime anything goes even remotely sideways with the economy, and when things go badly awry with the economy, stepping in strong and hard and staying in the market longer than they should, I would say yes. Would I guarantee it? Would I even say like 2 to 1 odds? No, but better than a 50-50 shot that we will absolutely see them in the 4s, probably in the 3s at some point in our lifetime.
Great. All I hear is hammering in the background, just like, they might as well just move into the office here. Let's see. But what I would say, Josh, is that I complain all day that they should do this after hours. And I guess
And then they do it after hours.
It's after hours. So, I mean, I'm one of those people that's going to complain either way. So in this situation. All right. There was some good questions here. Big G's asking, when will inventory increase? That is a really good question. I think that you're going to see the peak in inventory here probably in the next 2 months, in my opinion. But a lot of it has to do with rates, right? If you see interest rates go significantly lower, you might see inventory pick up a little bit. But in addition to that, you're going to see an increase in buyer demand. So is it real pickup in inventory? Hard to say. If interest rates go higher, I actually think that makes inventory, go down to some extent, right? Because you're not going to see a lot of people want to list their homes unless, like we said, there's some major, recession that happens where you have major unemployment, much above the 4 to 5% that is being, sought after by the Fed. And I don't see a world in which that happens. So I don't know when you see inventory increase. I think this is a situation we've never been in because people have never been, in a position where interest rates were so low that moving, is that much more expensive. You normally had to deal with, okay, the house price maybe went up a little bit, interest rate maybe went down a little bit. So yeah, the house is a little less affordable than it would have otherwise been, but nothing crazy. In this situation, price went up, rate went up. I don't know. I don't have an answer for that, Josh.
It's a very tough one to answer because why? Why would someone move? It kind of relates, when do you get rates under 4%? I think there's a lot of people that do want to move, that if they had to give up their 3.25 for 3.875, cool, that's the cost of doing business. But even giving up a 3.25, 3.5 for a 4.5, 5%, it's a different story. So inventory requires additional building, which the crazy thing, it's sort of a paradox, right? Here, Jeb, we keep talking about, are builders going to overbuild and then have to cut prices and prices come down? They want to keep prices elevated. They also want to be able to build as many homes to sell at those elevated prices without causing the prices to come down. So the long story short version of this, Jeb, is the government should just stay out of the way. Prices wouldn't be as high as they are. Rates wouldn't be as high. Rates wouldn't have gone as low. Everything would be on a more even keel, but that's not the world we're ever going to get to live in.
Nope. John is back telling us both old guys are on. Last week we were young guys. Now we're old guys again. KK has a question, says, my bank lender's offering a 5.75% rate for a 10-year fixed ARM. Is that something that is recommended in this climate?
I don't have a problem with it. I mean, if you're looking at the comparison on a 30-year fixed, we showed the national average 6.5%, a 0.75% discount, and you're locked in for 10 years. Do I think there's going to be a refinance opportunity in the next 10 years to maybe get a 5% or a 4.5% 30-year fixed? Absolutely. So I would take the discount. This kind of relates, Jeb, to another question here. Dina was saying that she is going through a bank and the bank told her they don't have LLPAs. If it's truly a bank and they're loaning their own money and they're not going to sell that loan in the secondary market, they don't have the LLPAs. They can do anything they want. We recently lost access to one of my favorite lenders, it was a credit union. They didn't have any LLPAs, the old ones or the new ones. They've shut off all lending because their cost of funds is too high and they have more mortgages than they want in the current environment. So we kind of talk about lender money can do whatever they want. They can discount that 10-1 ARM. They can not have the LLPAs. So we talk about when you're going to shop for a loan, it's never a bad idea to check with a credit union, to check with a local bank. Sometimes they're awesome, sometimes they're not. And there's more to it than just absolute rock bottom lowest interest rate. Hopefully they can advise you and guide you along those lines. But if they're loaning their own money, very different than the majority of stuff we talk about here that's going to Fannie, Freddie, FHA, VA.
And a follow-up question for Dina, or actually a question that came prior to that. She says, if I'm conventional now under contract, could I change to FHA to avoid LLPA? So ask that. I mean, let's take Dina out of the question. If you're under contract now and you're getting hit with these LLPAs, can you change to an FHA loan? I mean, I guess this is a two-part question. We can ask from the mortgage side. We can ask from the real estate side. But on the mortgage side, does it typically transfer over from one loan to the next?
So we would have to get FHA appraisal has some requirements that are not required on a conventional appraisal. So if the appraisal's already been done, we might have a cost to upgrade the appraisal to meet the FHA requirements. In your situation, if you're getting a loan from a bank and the bank is legitimately loaning their own funds and doesn't have any LLPAs, they probably don't do FHA loans. So if you're with a lender that doesn't do both, it's not as simple as switching. If you're with a broker, almost all of my lenders, not all of them, but almost all of them do both. So if we have your loan in process and it's already placed with the lender and it's in the underwriting queue for conventional, fairly easy to switch it to an FHA. It'll cause a day or two delay, but you may literally have to switch lenders if it's a bank and they don't offer FHA, which a lot of them don't.
And then on the real estate side, it could or could not be an issue depending on the type of property that it is. If it's a condo, it's not FHA approved. That can change. The timelines on that loan getting approved. It can mean it doesn't get approved at all, depending on whether or not you can get a spot approval on that particular unit if it's not, FHA approved. In addition to requirements of the property, like Josh said, with it being FHA, not all properties meet FHA requirements when it comes to an appraisal. So talk to your lender if you're in that scenario. Talk to your lender, have your lender, as well as your agent, have them talk together, and then you might need to talk to the other side as well, just to make sure everybody's on the same page and you're not surprising anyone by changing the type of loan, because obviously that's a violation of the contract, in which in turn they could basically, cancel and move forward with another type, another deal if they wanted to. So not at least here in California. Other states, the contract might be written differently, but here in the state of California, you tell what type of financing you're doing. Therefore, if you change it, that can change things. So hopefully that is helpful for you. Jessica, one of our regulars on here, asked the question of what are some of the responsibilities, roles of an agent if you purchase a new build? So they're essentially the same as an existing construction, although there's less control in the situation of a new build. But, the agent still has to, help you review disclosures, help you, get the inspection, review the inspection, decide how you're going to respond, working with your lender to make sure that the process still moves timely, make sure everybody's on the same page. So it's a lot the same. But I would say with new construction, you have the chance of probably less hiccups coming from the selling side, just because, other than maybe time delays on the actual building of the property. But with regards to everything else, it should be pretty smooth for the most part. But much the same. I mean, the process shouldn't change a lot just because it's new construction, although it'll just be a little bit different. But for the most part, it's all the same. Josh, is there a good reason to retire your mortgage if you have a 2.5% interest rate? So we've talked about this a little bit. Getting towards the end of retiring, you have a low fixed rate mortgage. Should you pay it off? Should you keep it? What's the benefits? Thoughts?
The biggest benefit is a simple life. If you don't want to deal with making a payment every month, if you don't want to figure out how you're going to get greater than a 2.5% return on your money elsewhere, it's pretty easy to do in the current market. It won't always be. You can always push that decision off later. You could buy, a 3-year CD and get more than your 2.5%, and make that decision a little further down the line. The argument for not doing it is just remaining liquid. It used to be there were some tax benefits at 2.5%, and with a loan that you can write a check and pay off, probably not super significant interest write-offs there. So you can make an argument for it. Just what does that do to your liquidity? I've seen people do it and then be upset 4 years later when they needed some money for something and had to go do a mortgage at a higher rate to get their money out. So consider your situation. It certainly can be argued for, and there's certainly situations where I would say absolutely not. But without seeing your finances, it's hard to say.
Do you ever see people comment in the comment section that have no idea what they're talking about?
Yes.
You do. Okay. I just want to make sure I wasn't the only one. Anyway, Gabe says, got my first and only home through FHA loan in 2021. Goes on to ask the question, will the PMI ever drop off? So Josh, PMI, FHA, how does it work?
FHA is on it for the life of the loan unless you put more than 10% down or got it more than 11 years ago, which in your situation is not the case. You got it 2.5 years ago, 2 years ago. So it's on there for the life of the loan unless you put 10% or more down. And even if you put 10% or more down, it falls off automatically at like 11 years. You can never ask to have it taken off. In my view, not a big reason against this loan. Most people will either sell or refinance out of it well before they hit that time frame. The last few years skewed people's perceptions of when they can get rid of mortgage insurance. It is not normal to have 8, 10, 12, 14% annual appreciation where you can get rid of your mortgage insurance in a year and a half. I think the record would we have Freddie down in San Diego got it done in like 7 or 8 months after buying the house. Normal. When you look at it, I would just account for it in your interest rate plus mortgage insurance. So in your situation, Gabe, you're at 0.85 when you originated your loan. It's down to 0.55. For the new ones going on the book, it's not that big of a deal. 0.85 is real. Like even if you got a 2.75 interest rate, which a lot of people did with that mortgage insurance, it's about 3.5%, which is still an amazing interest rate. So rather than looking at and parsing out interest and mortgage insurance and saying, I hate this, look and say, my effective rate is 3.5%. This is a wonderful world that I got to get into my home for so cheap. I wouldn't count that as a reason against FHA. We had a question in here, Jeb, when we were talking about people getting pushed with these LLPAs and those changes getting pushed to FHA. What are the downsides? Many people will consider that with a minimum down, with less than 10% down, mortgage insurance being on there for the life of the loan as being a downside. To me, it's a non-event. Most people are going to move or refinance out of that, somewhere 3-5 years down the line. So I don't generally think in terms of that. The one thing that I don't love about FHA loans relative to conventional loans is the upfront mortgage insurance premium. They're going to add 1.75% onto your loan to finance an upfront mortgage insurance premium. But other than that, the FHA loan is a really, really, really good loan. And there's ways, if you want to, we can get a lender credit to cover the upfront mortgage insurance premium, and you're still going to have a lower interest rate than what you would have on a conventional loan. So just make sure you're working with someone that does both and doesn't have a bias or a reason in favor of one or the other. I don't care. To me, it's 6 of one, half dozen of the other. We input your information into our loan origination system. We run it through an automated underwriting software, and we collect the documents that it says we have to have for the file. So just make sure you have someone that's doing both and doesn't have an agenda to tell you, hey, I only know how to do FHA loans, so you should do that. Or, hey, we don't offer them, so conventional are the best option.
All right, good. Let's go here. I saw a question that was Fred says, where are these 6% interest rates coming from? Just got an FHA loan from my lender, got a 5.5%, got it down to 5.15 by buying 1 point at closing. So Josh, interest rates change daily, hourly in some cases. So were interest rates in the mid fives? In fact, you showed me a quote today from FHA showing around 5.5% on a scenario.
Yeah.
So
yeah.
Yeah.
So FHA, we talked about the stupid FHFA earlier. FHA is not a problem. 5.5, easy. You want to pay some points? We'll get it into the low fives.
Well, I think he's referencing that clip that we had on the screen earlier that showed FHA was at like 6.12 or something.
And we talk about this. I have no idea why, but here's why. People get hung up on what channel you're getting your mortgage through: a bank or a credit union, other depository institution, a mortgage company, or a broker. The people, like a lot of the banks and credit unions, just don't do government loans, FHA or VA. Large banks, the direct lenders, they subsidize their conventional loan rates with really high interest rates on their FHA and VA loans. So when you see these national averages, that is big national lenders, mortgage companies, not depository institutions, that charge more than they have to. Any broker you call is going to quote you numbers similar to what Fred is seeing there. So from that perspective, FHA and VA, I would lean heavily towards you're probably better off in the broker channel. If you're looking at a conventional loan, it's going to be very similar between her and a broker. And this is painting with broad strokes. I am sure there are direct lenders out there that don't do this and are very competitive on their FHA and VA, but that's why you see national averages quoted that high.
Are you guys hearing, like, is he like going in and out occasionally? Not it's just randomly. Let me know in the comments, because I hear you and then for like a second you're gone and then you're back. So I don't know how it's actually coming through the other side. I assume it's coming like that, but just want to be sure. David says, seeing new home builders offering fixed rates at 5%, even a little below in some areas. How are they able to offer these better than market rates for new inventory? So Josh, we've talked about in the past, builders being able to potentially offer a little bit better rates in some cases. How do they do that?
So historically, they don't. They have terrible rates. They force you to go and get proof with their lender. They want control of the situation, but they're not willing to pay in terms of better rates to have that control. It's a very volatile market. They want the control of the situation. So they will subsidize and pay to keep you in that transaction, to have the control of the transaction, to make sure you're locked and you're not subject to interest rates moving around. And when you have, let's say you have a subdivision that you know we're going to have 100 homes available in this 60-day window, you can buy a forward commitment, and that is worth more in the secondary market. So there's multiple ways they're getting at it, but primarily they're paying for it. They're losing money. It's a subsidy to gain the control and make sure they're going to get that construction loan off their books as soon as that home is finished being built.
All right. So Josh, the consensus is your lens sucks, your microphone sucks, and now your internet connection sucks. So we appreciate you here, Ben, but you're going to have to step up your game. With that said, guys, we've been on an hour tonight so far. Got another hour-ish to go. Would appreciate it if you find any value. You hit the thumbs up. You share us with a friend, somebody that's buying a house. Mention us, mention the show here on my channel. Go over to the Educated Home Buyer YouTube channel, subscribe, like those videos, watch them, check us out on the podcast. However you listen to that content, we would be forever grateful. We enjoy providing the information and hope that you guys find value in it, and you can show us by doing the things that I just mentioned. So, and then something I haven't mentioned in the last couple of episodes, but I do want to mention is happy to connect you with a real estate agent, a mortgage professional anywhere in the country. So, we're in Southern California. You can be anywhere in the US, and we can connect you with somebody that, we know, like, and trust, that can guide you through the process, that handles transactions like Josh and I do. And you can get there through that referral link below. Josh, have you fixed your mic?
I don't know. I don't know if we fixed it or not, but did you know that there's no cure for stupid?
There's not. And I see it because I continue to see ridiculous, moronic comments coming through the comment section that just make zero sense, that aren't data backed. It's amazing. Anyhow, let's do this. Kim says, "What am I drinking tonight?" So I have a bang. I drink one of these a week on the show. That's when I do it, primarily to get a sponsorship. They haven't reached out yet, so I'm a bit sad with that. If they send them to me, I would probably drink more of them, but I don't. Josh is dealing with high blood sugar now, so I'm not sure he's going to be able to drink anything but water. He's getting old.
So
Things
we've
are
got
changing.
a little H2O with some element in there, and just so you know, Jeb is the only person on the planet that can drink caffeine, like large
Right.
doses of it, not like a Coke, like crazy bang,
don't
about
drink-
5 minutes, and then go put his head on the pillow and fall asleep. And
For
not only
sure.
that, sleep well. So we both have a Whoop strap, and we're in a group that measures everything. And Jeb wins every week with the highest sleep performance, despite the
Yeah.
fact that he's drinking caffeine at 6 o'clock at night. And if I did that, it
It's
would
not
be
every
7,
night.
7
One night a week.
a.m. before I fell asleep.
One night a week, dude. That's it. So Josh is dealing with high blood sugar. I've got 2 hernias, I find out today. Guys, so May 11th. May 11th's the big day, guys. Surgery. Hernias are going to be fixed. I'm going to be as good as new. I don't know what to tell you. I've been dealing with pain for like 18 months. So I'm coming back with a vengeance, guys. A vengeance, I tell you. Anyhow, side note, we got off track.
Darren had an important question. He wanted to know. He said he thought the Educated Homebuyer podcast was the cure for stupid. Well, then that lets you know
only
that
if you actually
some people aren't watching.
Only if you trust the data in there and the information given. You know, like that whole "you can lead a horse to water" quote. This is very much the same. We're trying to lead the horse to water here by giving, the place where you can find the information that you need to make sensible decisions. Not everyone's going to do that. Bearded Vato, smash that like button like it owes you money. I like that. I like it a lot. Yeah, exactly. 2 hernias from carrying the podcast. All right, here we go. Let's see. Oh, and Shay basically came out and told Josh that she's a female. Just so you know, you've been calling her
A
a male
little
this whole
one
time.
too. She's a little bit bigger than Anya and Dina, but only 5'2". So apparently we've cornered the market on short in stature females.
Hey, I thought the whole time female, and I was wondering why you were going male. I thought you knew something I didn't. Clearly you didn't, Josh. You were just misinformed.
I know nothing.
You were misinformed. Here's a good question. We didn't really address this earlier, but for a second home, I can't do FHA. What is now the requirement? How does Biden mortgage rule affect this? So LLPAs, how does that affect a second home? Are there additional hits for that on top of credit scores and all of that, Josh, or is it primarily just around credit score?
No.
We
got new LLPAs last year for investment properties and for second homes. We went from, it used to be second home, you had to put at least 10% down. The pricing was the same as a primary residence. So these wizards said, hold my beer, we got to fix this. So let's go here. Second home, you can still do it with, it looks like they now have where you can do it with 5% down. I got to go back and look at the guidelines. The matrix doesn't necessarily match up with the guidelines, but the matrix shows a hit even at 95 at 4 1/8. So anything with less than 20% down is a 4.125 hit. So we go back to Kim's question earlier that 1 point is generally equal to an increase in rate of 0.25% in interest. 4 points would be 1%, but in the real world, it's closer to 1.5% difference in interest rate. And in the real world, because lenders don't want to pay up for that, you're going to pay for that loan. You're going to be paying points to get it. There will not be such thing as a Fannie Freddie second home purchase without points. Now, if you went all the way down and you wanted to put, 40% down, you would only pay 1 1/8 points more. But even at 75, it's 2 1/8. So for the most part, on a second home, if you need to go Fannie Freddie, you need to put at least 25% down to get a decent interest rate. It's still going to be 0.5% above the market. So that's a situation where we would want to look at other lenders. We've got other options that don't sell to Fannie and Freddie that are happy at 20% to take those off your hands. And some credit unions are still doing them with 10% down with no LLPAs. So if you're in that space, you definitely want to look at what your options are.
Good. Dina has a quick and easy question here. When's the next meeting to determine if rates will go up? It's next Wednesday. It's the 3rd. So they're going to meet Wednesday, and then I believe CPI data comes out the following Wednesday. So the next 2 Wednesdays prior to our show, we're going to have a lot to talk about. So it'll be interesting nonetheless. Purnama. What are the top 5 things to look for in my contract? So that's a difficult question to respond to, because it's different for, different states. The contract varies a little bit. But I would say, assuming that you are working with your agent in filling out the contract, you should know most of what you should know, if that makes any sense at all. But I think the main thing to be aware of is, when is your escrow deposit, when is your earnest money deposit no longer refundable? Do you lose any money by canceling the contract? That's really what you need to pay attention to and what you want to know, because other than that, if you go under contract and you cancel, as long as you get your money back, do you really care? In some cases, maybe you've wasted a little bit of time, but if there's no money gone, then you're more or less in the same position. So I would say that's the main thing you want to pay attention to, but you should already be aware of the price that you're offering, how much money you're planning on putting into an earnest money deposit, because these are things that you should be discussing with your lender. You should know how many days until you're closing. You should know how long you have to do your due diligence on that purchase, as well as what you're asking the seller to pay, as well as what you're saying that you're going to pay in the process. Outside of that, most contracts are, boilerplate, template documents that very little of the verbiage language can you change. So, those are really the things I would focus on. But a lot of that should be addressed prior to you signing the contract. Therefore, you should be in good shape.
So, Jeb, we
Yep.
have an interesting debate going on here, much better than LLPAs. Kim says she heard the watermelon flavor was the best. Dina says, watermelon. And then Michael comes back in with cherry blade lemonade or purple haze.
What are we talking
the
about here?
best. Well, I didn't know whether they were asking about
yours?
Element or Bang. So Michael, I believe, is talking about Bang. But I don't know, the girls may be talking about Element, because the watermelon Element is really, really good, but not as good as the citrus blast or whatever the heck tastes like old school Gatorade.
There you go. And I'm not a Gatorade guy, so there we go. I have nothing. Bang. They're talking about Bang, bro. Bang.
They want caffeine at 7 p.m.
I like the Star Blast or whatever it was, but I don't even like peaches or mangoes, quite frankly, but I like the peach mango. So here we are.
White gummy bear rain is the best. White gummy bear rain.
That sounds like something you would take at a rave.
I do. Before every rave.
All right, there we go. Josh, how many people were successful in the Dream for All through you? Did you get any through?
We have one that is approved that we are working its way through the system. We had another one that the lock was requested, and prior to the lock being confirmed, they shut the program down. So 32 applications, one person got under contract and locked and reserved.
All right. Pulse Powered is flood insurance for new homes necessary. So Josh can speak to this a little bit. It's not necessarily for new homes. It's for areas that are in flood zones, right? So FEMA has a map that shows different flood plains, if you will, flood zone A, B, blah. I don't know if it's A or B, but I know flood zone A is like the big one. But if your home falls in one of these flood zones, if you will, then the lender is going to require some form of flood insurance. And the reason I said Josh could speak to that is because he lives below sea level and has flood insurance.
Yeah. And the funny thing is, these flood insurance companies are crazy. When we moved in, I think it was $800 or $900 a year, and it crept up to almost $2,000. And then one year we got a bill that said it would be $5,500. I said, wife, we are moving. So one of our neighbors also got one of those notifications and pointed us in the right direction. And someone did an elevation cert. So if you're in an area where you think that your flood insurance is too high, contact a flood insurer that will do the elevation cert for you. It'll generally reduce the cost a good bit. And looking for the private flood insurance versus is it FEMA? Who does the flood insurance? Whoever, the
I think it's
NFIP.
FEMA. Yeah, it's FEMA.
So whatever, it's not fun. So if at all possible, I suggest not doing that. Jeb actually sold someone a lot of a home that was in our flood zone that was burned down, and they mistakenly took the house down, and now they can't rebuild. And
So
Jeb,
let's tell the whole story here, or what I know of the story, because this could be completely untrue. But so quick story here in Huntington Beach. There's a big portion of kind of where Josh lives that is below sea level, or sea level at best case, right? And so what happens is falls under flood zone A. This one particular house, nice little cul-de-sac, pie-shaped lot, great little area, happened to, I don't know if it caught on fire. I don't think it caught on fire. I think they were going to rebuild it. So they tore it all down except for one wall in the house, and we're going to remodel the house. Well, because what happens is, as long as you leave one wall, you're essentially, you get grandfathered in to city code and being able to do all of these things. Well, if that wall comes down, well, then it's considered a new build. New zoning, all of this crazy stuff comes into play. You got to get permits with the city. You got to get permission from the city, all this stuff. Rumor has it that one of the neighbors that didn't want them to rebuild came and pushed the wall down. Therefore, the wall was gone. And so now it's a new build. So these people fought it to try to build there, couldn't figure it out. I don't know what happened. They ended up selling the lot. My client bought the lot, had it for a couple of years. I ended up selling the lot, going to the city to try to figure out how they could rebuild there. And it was a lot of red tape because it was zoned flood zone A. The city of Huntington Beach was basically like, it's an unbuildable lot because of, the flood zone, all of this crazy stuff. We ended up selling it. Somebody bought it. And I think last time I drove by, it was still an empty lot. Josh, have you been by there?
6-8 months ago, I walked by
I've
there.
been by there probably
It was
since then, but not recently.
Very, very vacant.
Yeah. So anyway, just something to be aware of. Fun little story. Which one has cheaper closing costs, Josh? A HELOC or a cash out refinance?
The HELOC, most banks and credit unions will do them at no cost. If you go, like, people will reach out and ask me, can you do a HELOC? Yes, I can. And unless they have a unique situation where you need to go to high LTV, lower credit score, something outside the box, you're going to be better off going to a bank or a credit union because they're going to offer slightly lower margin, and they'll generally do them at no cost. And if they don't do them no cost, call a different credit union, a different bank. They should do it. And on that topic, credit unions are generally more aggressive in terms of loan to value and that type of stuff than the banks are. The banks got super restrictive. They got burned really bad in the last downturn. So I would highly suggest checking with the credit union. And if they will make the loan to you, it's going to be cheaper, always cheaper than a cash out refi. I mean, we can do a no cost cash out refi for you. But again, most people are at rates significantly lower than where the market's at right now.
All right. World Trekker says adding approximately 160 square feet for $100,000 or less, but will sell the house in 20 years. Is that good ROI NOC? What you should do, World Trekker, is listen to the latest episode of the Educated Homebuyer podcast, where we talk about value adds to property. This is one of those things. Adding additional square footage to your property, in theory, is increasing the value of your property because it's more square foot. But it all depends on how that square footage is being used, whether somebody finds value in that square footage. Is it an additional bedroom? Like, what is it? And each person's going to look at it a little bit differently in that 160 square feet. And here's the thing. Cost to build it being $100,000, adding 160 square feet. What's that? $700 a square foot to build that? It's expensive. Is it worth it in 20 years? Who knows? I mean, I think in 20 years, you're probably going to forget what you paid for it and what you did. And it's just, does it provide value to you now? That's really the question. I think it's less about the money and what you're trying to get out of it. And how is that 160 square foot, 40 by 40 going to impact your life? Does it truly give you value? If it does, then does it really matter what it costs at the end of the day? Because I think that's the key, because you have such a long-term time horizon or a long time horizon. I don't know that the cost really plays into it, in my opinion.
Jeb, we've got a similar question. Let's just stay on that topic. Having a new house built in California for $497,000, I'm putting down $240,000. Will I have good equity when I move into this home? So a couple things there. By definition, if the property is worth what you pay for it, you're going to have 50% equity in that property. So you're going to owe 257, and hopefully it's worth 497 or more. Where you can run into issues is, so you're having a new house built. Is the builder building it and they're responsible for the construction loan? Because if you're on the hook, you can have cost overruns, you have carrying costs through that time frame, and it'll eat into that. But anyway you cut it, you're putting a massive down payment down. Yeah, you're going to be good.
All right. Bankroll TJ, what do you think of a seller paying down points for a buyer and assisting with their other closing costs? I think it's great if you can get a seller to do it, but also understand if a seller is willing to pay for your closing costs and buy down points, they're also willing to probably lower the price, and you're able to buy the house for lesser money. So you have to think, do you want that sunk cost paid for by the seller, where you could be refinancing in a couple of years anyway, or had you rather have the lower price of a home? It's up to you, right? It's to each his own. I don't know that there's a right or wrong answer. Really just depends on where you are and what you're trying to accomplish. I think the majority of people, if you believe the interest rates are going to be lower, I'd rather get the house for a little bit less money, because here in California, your property taxes are based off that price. Your monthly payments based off that price. There's a lot of things based off that price, and having it lower, it may not be a significant amount lower, but lower long-term impacts everything else. So my thoughts on that.
It's your money one way or the other. No one's paying it for you. We're financing it. Look at it this way. You're financing it or not, because exactly as Jeb said, it's your money. They're not just giving it to you out of the kindness of their heart. Hey, I'd like $10,000 less at closing. Let me pay this for them. They're saying, I would take $10,000 less, but if you'll pay 10 more, I'll give it to you to do with as you wish.
We got Platinum Black going with was that Reagan tear down that wall? Yeah, they tore down that wall. Anyhow, here's a good question. Joey says, any upcoming economic indicators that could affect the MBS market and mortgage rates? So I think we have PCE on Friday, which could have an impact. It's kind of one of those things that they're not paying so much attention to at the moment, especially since CPI is coming out next Wednesday. But CPI is really the big one that I think is going to have an impact more so than anything else. But you got jobless claims tomorrow. Unemployment next Friday.
The April employment report coming out next Friday, and then you got the Fed meeting the week after that, and CPI the week after that. Those would be the big ones coming up.
Yeah, and they're Barry Habib, which we've quoted many times on the show. Not the end all when it comes to interest rates, but somebody that we follow closely and smart dude, seems to think that May 10th, when the CPI data is released. I said CPI is released next Wednesday. That's not true. Fed comes out and speaks next Wednesday. CPI is the following week. But seems to think when May 10th, when that CPI data is released, is when you'll start to see shelter and rent and inflation numbers adjusting because they're lagging indicators or lagging data, if you will. And when they're reported, it's going to show a bigger than expected drop in inflation and in turn improve rates. So the next 2 to 3 weeks are going to be interesting, as we said.
Part of the thing that I don't like, Jeb, is when you said that the Fed is next week, I was thinking they were the week after, which is after the employment report. They're really looking closely at employment. Now, if they're releasing their findings on Wednesday, this has happened a couple times recently, and they swear that they do not get an advanced look at that. I have a hard time believing that they're not getting an advanced look at that employment report. But I guess.
And here's the thing: is right now we're in the blackout period, so none of the Fed members are actually speaking. So we don't know what the heck they're thinking. I looked up today Fed probability at the moment, 70-ish%, 75-ish%. I can't remember the number exactly. Are expecting another quarter point rate hike in May. 23% are expecting 23, 25, whatever that number is, expecting us to stay where we are. And then when it moves to June, the large majority, I think it's 50% are expecting us to stay at that 0.25% hike. 20-30% are expecting us to be where we are today. So 80% are expecting no more hikes at that point, which is essentially that pause that people have been talking about. So the Fed's actually coming out earlier than the data, which I don't think is it's all predetermined. So it's not like, hey, strategically they could do anything differently, but it just kind of sucks that they're not latter to be able to see the actual data come out before making the decision.
Do we want to discuss the topic that does not get discussed? Or
no.
World Trucker's next question. You don't want to go there?
I didn't see it. Hold on. Let me see. Let's address this one real quick. Is there a 55 plus community in SoCal where I can buy the property under my name without adding my parents into title? I don't understand the question.
I don't.
So are your parents going on the? I don't understand. So Alex, help me out with what you mean by that. There's a lot of 55-year-old plus communities where you don't have to add your parents to title. So not sure. In fact, you don't have to add them to title ever if you don't want to. But I don't think that's the question. So let's help clarify. Josh, I don't know what question you're talking about, but let's solar. Is that what we're talking about?
Yeah.
Yeah, let's do it. What don't you like about having solar? Most people in SoCal and San Diego are putting them. San Diego Gas and Electric raised the rates. So Josh, shall I go first or you want to go first?
So here, I can tell you, for Jeb and I, we live in Huntington Beach, coastal Orange County. I have air conditioning. We use it maybe 20, 25 days out of the year. It's very nice when we have it. My utility bills are really low. I have the world's greatest solar roof. It's like my wife, when we moved in, said it is perfect for Santa because he's got the world's biggest landing strip. So with that, it faces the sun. I can throw solar up there, but it's going to be ugly as sin. So for me, that is one reason. I don't know if you guys have seen Google Project Sunroof. You can plug in your address. You can plug in what your average bill is, and it'll tell you how much sunlight you get, how big of an installation you could put on there, and what your repayment period is. Every time I've looked at it, it's like 30, 35 years before it would break even. I'm not putting a horrifically ugly thing on my house that I'm going to be 85 years old before I break even. Combine that with, I've seen multiple neighbors in my neighborhood who have thrown up solar only to have the people back out 10, 15, 20 times to repair the panels, repair the leaks to the roof, all of the things that would have never been a problem without it. So cost versus benefit is very, very minimal. Now, that being the case, if I lived in Rancho Mirage full time and I ran the air conditioning 200 days out of the year, 20 hours a day, it would probably change the calculus for me. I just think that most people get excited and think they're saving the universe and don't actually run the numbers to find out how long it's going to take for them to actually benefit. Jeb, on top of this, I had a meeting with a loan officer at an industry event last year, and they built this really cool little tool that they could look this information up as they were walking and knocking door to door. He had salespeople knocking door to door saying, hey, we'll do a refinance. We'll put the solar on. Here's how much you save between interest, this, that, and the other. And he explained to me that, like, this is something you absolutely have to shop. Like, they can price it however they want. Most people just go, oh, that's what solar costs. Is this, you can put a $60,000 installation in that costs you $20,000 that the person could have got for 25 grand if they'd called someone else. So do your numbers, check with multiple sources and see what you can do to get the number down. But if you're in an area where you have a high utility bill that's $200, $300, $400 a month, it can absolutely make sense.
Yeah, I don't really have much to add to that. It comes back to cost benefit analysis. I get the idea behind solar. I think it's great. I think the idea is great if you have a high utility bill, if you're running, you're heating your pool all the time, jacuzzi, you're running the air conditioning all the time, you have an electric car, like all of these things at once, right? That for me is a reason to have it. I think the large majority of people out there aren't doing all of that. And what I see is, for example, I'm making up these numbers, but somebody's utility bill is $250 a month and they're paying $250 to solar. Like, they feel like that's a good deal. And for some, okay, maybe that's a good deal to you. To me, that's a break even and no reason to put solar on my house because it involves a contract for, like Josh said, 30 to 35 years in some cases to pay the stuff off. It makes selling your house a nuisance in some cases. Those solar panels are only warrantable for like 10 years. And guess what? What happens when they need to be fixed? You have to pay for it. And when issues arise and when you have to replace the roof, those have to come off. And I know some contracts will take them off one time in order for you to redo roofs and that sort of thing. It's just, I don't know. It's just more than I want to get into. And I think the technology is advancing. I think that, the cost is going down. I think it'll be a lot less expensive in 5-10 years to do this sort of thing. So for me, I don't see a huge benefit, but that's it. Sorry, that was really long-winded way of getting to the same answer. But for some people, it's right. Some people, it's not. Alex comes back and said, okay, I don't want to add my parents into title. So could you name some SoCal 55 community that I could buy under my name and let my parents live in there? Is the Peacock at Oceanside? I have no idea if Peacock and Oceanside is one of them. So here's the thing with a lot of 55-year-old communities, the property just has to be occupied by somebody that's 55 and older. Doesn't have to be owned by somebody 55 and older. Now, some may have the restriction that you have to be 55 and older to own it. That is where, if that's your question, I don't know the answer to that. But in Southern California, you have communities like Laguna Woods, different communities where you can buy these units. Laguna Woods, I'm not sure if you have to be 55 or not. I just know you have to be 55 to live in there. And like if you can't have kids and that sort of thing in these communities as well. But a lot of times you can buy it for your parents and not have them on title. But I don't know the answer to your question per se, because I think each one of these communities is going to vary a little bit. But if you're looking in a particular area and you're looking for something specific, let me know. Happy to connect you with an agent in that market that knows that area and can guide you. Sounds like you may be in Northern San Diego. If that's the case, I can put you in touch with somebody that knows that market. So reach out. My information is scrolling there. You can use that link at the bottom. And you go on to say that most 55 require owner to be 55 plus. I don't know if most require the owner to be 55 plus or the occupants to be 55 plus. That's the caveat, is the occupants in many cases. But I could be wrong with some of those. Kim, when and what topic is the next podcast? So that's a good question, Kim. Today we recorded gifts, buying a home using gifts, where that money can come from, stipulations on gifts, how it can be used, everything around getting a gift to buy a house in some form or fashion. So we recorded today. In theory, that comes out next Tuesday. The catch, got a lot of questions around LLPAs. We might be recording a podcast tomorrow to talk about LLPAs in more detail, more so than we did on today's episode, that we might replace that episode with. So one of the two. If not, gifts will be the following week. So just so you know. Josh, you see any questions here? Where are we? 6:30 in. We're 6:30 in. 87 likes on the channel. If you're finding any value, hit the thumbs up. If you're not subscribed to my channel, how many people in here are not subscribed? That's what I want to know. If you're not subscribed, let me know. I just want to know. I want to know who's not subscribed, because I want to see if it's a regular name. But I find that hard to believe. And Rich says, are you guys on Apple Podcasts? Yes, we are. We are. But we're also on YouTube. If you want to check us out on YouTube, check us out there. Josh, where do you want to go?
Here's a question. Keto in the midst, and I could be wrong, but I believe this is a new subscriber to the podcast. But comparing Shinoa Fund, Cal HFA, GSFA, down payment assistance options, any thoughts on the overall program advantages? I qualify for all three, but don't have rates from lenders yet for comparison. They're all going to have above market interest rates, so there's nothing for free. GSFA, I'm not all that familiar with, but Cal HFA, they're going to give you a second and or a third. So you end up with a above market interest rate and a second and possibly a third mortgage against your home. For obvious reasons, I don't like that. Shinoa has an above market interest rate that subsidizes you getting in. So what I always tell people is, if this is the only way for you to get into the market, I'm okay with it. I would be more wary in the current market where we don't think that prices are going to be appreciating nearly as rapidly as they have for the last 10 years. What I would love to find out is if in the price range you're looking at, if there is any way you can come up with your own down payment, because generally you come up with the down payment, we can get you a lender credit, a seller credit to get you in with just the down payment at much better terms with no subordinate financing than those options. So I would love to hear if you want to reach out once you get the numbers from the other lenders. I'd like to review them. I'd love to see. We just don't do GSFA. Shinoa and Cal HFA, I'm not a huge fan of unless it's your only option to get into a home.
Awesome. All right. I don't want to go down a rabbit hole on this, Josh, but I do want to address the comment, not a question, around Arnold saying that 2 more rate hikes will bring home prices lower. So we know that one rate hike is essentially built into the market for the most part. We've been hearing about it since, I don't know, last couple of months for sure, right? So what are your thoughts on rate hikes lowering house prices? Does that have anything to do with house prices?
What mechanism would the Fed and the terms that they set for banks lending money to one another have an impact on home prices? We've talked about this before. The Fed does not set mortgage interest rates. The market sets mortgage interest rates based off of inflation expectations. So the market looked and watched that inflation was high and increasing and staying persistently high. The Fed looked at the same data and said, we need to stop that. We're going to start hiking. So at some point, it would be pretty wise to believe that that's going to work. We believe it already has started to work. So when inflation starts coming down, mortgage rates will start coming down when they believe inflation has peaked and is decreasing. So a Fed hike does nothing other than confirm the market's belief that the Fed took this seriously, stepped on the brake, stepped on it for too long, just like they stepped on the gas and stayed on it for too long. So it is more likely to lead to lower interest rates and higher home prices. So it's an interesting thought, and I understand kind of where you're coming from or why you might think that, but it is the exact opposite of how it works in the real world.
All right. KK clearly wants this question answered because they've posted it in here more than one time. So I'm going to address it. It was in the list to get to rather. I'm in the Northeast and we're seeing a 25% increase in sales prices from last year. That seems high.
Seems very high.
Seems very high. And I'm now targeting a multifamily condo as I think it's a safer risk with today's climate. Would you agree? I would not agree. I don't. The two aren't correlated, in my opinion. A condo multifamily isn't any more safe than a single family home. In fact, I think you probably have less buyers of a multifamily than you do of a single family home if you went to sell it, just depending on cap rates and that sort of thing, getting into a whole different conversation. So I don't know if one is safer than the other. One is probably less expensive and or more expensive. Condo is probably less expensive than a single family. Multifamily is probably more expensive than a single family. So I think it's all about buying when it's the right time in your life. Again, not getting caught up in tops and bottoms in markets, not getting caught up in what Josh or Jeb is saying about where the market's going to be. Can you afford the payment? Are you comfortable with it? Do you have money in the bank? Do you have job security? These are things that you need to think about. Stop worrying, in my opinion, about where you see the direction of housing going. Just my 2 cents. And that's not meant to to be taken as, a derogatory or, comment or, towards you, because it's not that at all. It's just too many people are caught up in things that don't matter at the end of the day, and not focusing on the things that do. Josh?
No, that's.
I'm not looking for anything there. Just
no. Be very careful in terms of We know that the Northeast has been much stronger than most of the country. So definitely, we're not doubting that home values have gone up. I think 25% is very aggressive. I'd be surprised if it was double digits. 8 to 10% would be a high number. But
Yeah.
in terms of those types of properties, generally condos are more like the tech stocks where they're more volatile. People prefer a single family residence. They're more liquid than multifamily. They're preferred over condos. So as Jeb said, affordability may be there and be better, but I wouldn't necessarily think it's a better investment or going to do better for you over the long haul.
All right, two really good questions here. One is from Rich. Rich says, oh no, that's not it. Sorry, Rich, your question's not one that I was thinking
Your question will not get answered.
No, is a HELOC variable? It is. Home equity lines are variable.
Just think in terms of this. It's a line of credit. No one is going to give you a line of credit that you can borrow against and pay back, borrow against and pay back, and not have it variable, because that makes them exposed to the interest rate risk and you being able to borrow when it's beneficial to you. So yes, a line of credit will be variable.
So sorry, Rich, didn't mean to rain on the parade there. This is the question. Hola, El Mundo says, what is a par rate? Josh, question. We talk par rates all the time. Lenders talk par rates without really explaining it. So I think it's a really good question to address.
It's essentially the 0-point interest rate. So the lender is not requiring you to pay points to get that rate. They're not giving you a credit for taking that rate. So on any given day, the par rate is the rate that they want to lend at. If you want a lower rate, cool. You pay them 1 point, 2 points, which is 1 or 2% of the loan amount, a half point, whatever the number is. Or as we talked earlier, I believe Kim was the one that asked the question, that if you're willing to take a higher rate, they'll say, cool, we're gonna make more money over the life of the loan. We'll pay you a half point, 1 point, 2 points, that percentage of the loan amount to help you cover your closing costs and get in with less cash out of pocket. So when rates are high and likely to move lower, not a bad idea to do the premium rate. You're already paying a high rate. So if you can afford it, take the premium rate, have them cover your closing costs, so that way you don't have any sunk costs in the loan when you're likely to refinance in 6, 12, 24 months. On the flip side, if you think rates are low and likely to go higher, and this is the best it's going to get, then it can make sense to buy that interest rate down by paying points. But the par rate is generally your 0-point rate that you're not paying for or getting a credit for taking.
All right. Another good question here. If you've never rented or owned before, how do you know how much of your income you should or could spend on a monthly payment? Good question. I think it's going to be different for each person, but what I would do if I were in that position is I would start with a budget. Write down how much income you bring in, write down all of your expenses, how much do you take home out of that amount, right? And then from there, how much do you spend on groceries? How much do you spend going out? How much do you spend on gas, childcare if you have kids, all of the things that you spend money on? How much money do you have left? How much are you putting in savings, right? Every month. What are you comfortable out of what's left spending on a payment? Can you cut some of those things that you're spending money on to put towards that rent payment so that you can pay a little bit more if you're not able to get what you want with the budget that you have? That's really what you have to think about. I think it's foolish to say that you should use 25% or 35% or 40% or because for each person it's going to be different. It's going to vary depending on how much you're putting away into savings and retirement and different things. And your net every month is going to be different than somebody else's net making the same exact money because of how you distribute that income, when it comes to you, that paycheck when it comes to you. So, and give yourself, some wiggle room there. Don't be married to a house. Don't be married to an apartment and renting it. Give yourself some room to have some money to do other things. That would be my opinion. Josh, let's address this. We addressed it up front, but it's a really simple way to address it. Here's what are your thoughts on the new law being effective May 1st? Higher income credit score borrowers will pay higher fees. What are the benefits of having a score over 800? We talked about this earlier in the show. Lynn kind of started the show first 10 or so minutes talking about this in a little bit more detail, or maybe it was a little bit after that. Anyway, at the beginning of the show, we talked about it. So go back and check it out. These fees that you're talking about are already in effect. So the May 1st date means nothing. All lenders are already pricing this stuff in. Josh, what does it mean? Are there a benefit of having an 800 credit score now?
Not really. So we talked about before, 740 and above would get you to the highest tier. Well, they added 2 tiers now. So 740 to 759, 760 to 779, and 780 and above. So you want the absolute best terms, get to 780. On top of that, mortgage insurance improves all the way up to, I believe, the maximum. So the higher you can get your credit score, the lower your mortgage insurance rate is going to be. The benefits are pretty marginal above 800. 800 will get you the absolute best terms. There are, at any given time in the market, let's say there's lenders out there that kind of specialize in middle of the road borrowers, moderate FICO borrowers. They may pay a premium or an incentive for those 800 credit score loans. So you're getting a subsidized interest rate so they can throw those into their pools of average borrowers and bring up that weighted average FICO. So there can always be benefits, but in terms of the loan level price adjustment specifically, no benefit above and beyond 780. 780 and 760 to 779 are priced pretty similarly. That 740 to 759, which previously got you the best terms, it's kind of punitive there. So you would want to be 760 or above, 780 and above if possible. 800 will help in terms of the mortgage insurance. And if you're in the jumbo market or a non-QM loan where they're obviously looking at their weighted average FICO in their pools as well, those lenders will pay premiums to get those better borrowers. So there's a benefit to it, not huge, especially if you're not into that jumbo or non-QM space.
GG follows up, says, for the densely economically illiterate folks like me, are there any professionals that help with budgeting? So, Dave Ramsey's kind of the guru on this. He's really conservative on budgeting and that sort of thing. But I think outlining of budgeting and getting the concept and the importance and all of that, probably the best out there, at least in putting it into video and book and what have you. What's his book? The Makeover book, Josh? Do you remember?
Total Money Makeover.
Total Money Makeover. Great book for it. Probably a good place to start. Elementary to some extent, but really good information, kind of tell you importance of budgeting and really kind of help guide you as far as people directly that you can hire or do something with. I don't know. There's enough apps out there, Mint and some of these others, that you can use to help set with budgeting. But I think Ramsey's probably a good place to start. All right. Fred, are you guys seeing new build homes dropping in price more than existing homes in Southern California? No, I'm not really seeing any homes.
That's a false premise, right? The premise is homes are dropping. Which one's dropping more?
Yeah,
I didn't mean to cut you off, but go in that direction, Jeb.
No, I'm not really seeing a lot. I mean, we don't have a lot of new construction here in Orange County where I am. There's some in Irvine, some in Mission Viejo, South Mission Viejo, but overall, not a lot of here. You go out to San Bernardino, Riverside, some of those, maybe you have a little bit more. I would say in those markets, maybe if there's a surplus of supply in those, then maybe the new homes are dropping a little bit more. But overall, I'm not really seeing a lot of reductions in home prices unless the home prices were overpriced to start with. That's really all I have. I mean, I've seen a couple of new construction properties come to the market recently, and the only reason they've been on the market is they have some weird stipulation, like, one had tenants in the property until like October, right? And so property's been sitting on the market. It's not new construction, but it's like a year old. Well, it's not selling. Why is it not selling? Oh my God, it must be overpriced. No, there's tenants in it. And when you buy the property, you got to take the tenants on until October. Guess what? Nobody wants to buy that. Nobody wants to deal with having to get tenants out of property, especially here in California where tenant rights are, better than owner rights in many cases. So just take it with some context. I don't think you're seeing a lot of reductions overall just because of where supply is. I started the show talking about Orange County real estate. We have 2,013 homes on the market when I started the show. That's the lowest number that I've reported on this show this year. I saw it under 2,000 once, but it had creeped up before we actually got to the day where I reported numbers. So I look at it every day. Today's the lowest number of homes I've seen since the beginning of the year.
Jeb, we talked about if we could get Chat GPT trained to answer all the questions.
Dude, I see it popping up on my right here. What's going on?
Well, I found here that Michael De La Torre has listened enough that now he can answer the questions for us.
Hold on.
He has some suggestions here for budgeting. He's got the Money Guy Show, Humphrey Yang, Dave Ramsey, although outdated advice, Graham Stephan, Ramit Sethi. I will absolutely second that one. I Will Teach You to Be Rich. He actually has a show right now on Netflix. I can't vouch for the show, but I can tell you that his information and advice is really good.
Right.
So, Michael, thank you for answering for us.
So with the plugin that I have, like I just clicked on a question, and it says in the top right, like the corner, it's like let Chat GPT respond to this. And so the question is, let's see whose question it is. It's Fred's. Are you guys seeing new home builds? Does it say more than that? Because I can't see the question because it came up. And this is what it came up with. So it says, thanks for watching and leaving your comment. Can't see. Hold on. I'm trying to get back to it. Copy response and close. We're just going to post it and see what it says. Are you seeing new home builds dropping in price? Okay, so it didn't get the whole question, only got part of it. But here's Chat GPT's response. Say, oh, it's like a freaking paragraph.
It's like a book. You wrote it's a book. What are you doing here? You're spamming our comment.
I know.
Here.
Thanks for watching and leaving your comment. Yes, we are definitely seeing a rise in new build homes these days. It's an exciting time for the housing market as developers and builders are working hard to meet the increasing demand for housing. New build homes come with a range of advantages. First and foremost, they're brand new, which means you'll be first to live in them. That fresh, untouched feeling can be really appealing. I'm not going through this whole thing.
So the really long answer that we just gave you is that Chat GPT is a long ways away from replacing.
They're not replacing me. Anyway, that's where we are. So been on an hour and 50 minutes, guys. We appreciate you. We appreciate the support. It is my son's 11th birthday today, and my wife has ordered him food. His favorite food is orange chicken from Panda Express. I mean, I don't really eat orange chicken from Panda Express, but when I did, I remember it being delicious. So I have been summoned to go pick that up. It has been ordered. So with that, Josh, we are going to be exiting the show this evening. But I would like to say thank you to you guys who show up every week and support. Next week, we're going to have a lot of data coming in. Again, we got jobless claims tomorrow. We got PCE on Friday. We got the Fed meeting next Wednesday. All of this stuff is going to impact rates, which in turn impacts the direction of housing. So make sure you're here next week. If you're not listening to the podcast, listen to it. There's a lot of valuable information on there that we don't cover here, and it's in great detail. We're on YouTube. Subscribe to the channel. Like the video if you find any value in it. Josh, final parting words here tonight.
Next month is going to be interesting. Just an economic calendar. Want to see, I think it'll be a strong jobs report, but hopefully moderating a little bit. The Fed can see that the impact that they want is coming into play. They're going to do a quarter. Hopefully they don't do anything crazy or say anything crazy in there. They're going to stay elevated for a while longer than what people expect. But we should also see the shelter costs moderating in the CPI numbers. So again, this time next month, I think we'll have a better handle on where interest rates are and how the market is adjusting to that. And that will tell us the direction of the second half of the year in terms of home prices. It's not a crystal ball, but give us a good indication of where it's trending.
Awesome. And thank you to all you who wish my son a happy birthday. I will show that to him. He will be happy. One thing I didn't mention, but David mentioned it. This show goes on the podcast every Friday. So if you missed it here, don't want to watch our faces, but want to listen to it, you can go check it out there. But until next Wednesday, guys, Josh, this is your cue. Adios.
And vaya con Dios.